Hello everyone and welcome back to another video. In today's video, there are a lot of different topics that I think are very important and I want to discuss regarding the stock market. The overall market seems a little bit shaky right now based on fears that the US may enter a war with Iran. And if the market does correct in any meaningful way, then there are three stocks in specific that I think are extremely high quality and I am watching in case they get to the right price. And I want to cover which three stocks those are in today's video. JP Morgan also recently updated their guide to the markets, which shows us a lot of in-depth data on the overall stock market and how things are currently being valued. Vanguard also released a report and lowered their returns estimates for the US stock market over the next decade, and also showed where they are currently seeing value and potentially higher returns right now. Amazon CEO said AI is changing their business to the point where they think they will need fewer people in the near future, and the company's workforce is expected to start declining. I then want to share some charts that I made to help explain why I think that Brookfield is more set up for growth right now than ever before in the company's history. We're also quickly going to be going through Adobe's earnings as the stock is continuing to trade lower, even though they raised their guidance and looked like they had a pretty good report. And then lastly, I want to talk about the realities of being a consistent buyer in the overall stock market, and I want to show you how my real portfolio looks with a specific position since I have been averaging up on it for the past 3 years now. And I am still sitting on some pretty large gains, but I want to show you the mindset that I have around averaging up. And again, just the realities of being an investor who is constantly deploying cash in my portfolio. But with all that being said, let's dive into the video. And the first thing that I want to discuss is the charts that were shared from JP Morgan and Vanguard. So the first chart shows us the S&P 500's forward price to earnings ratio, and it also gives us this table right here of the 10-year bond yield. Now, as of May 30th, we can see that the forward price to earnings ratio of the S&P was 21.3, which is basically exactly the same as what was the forward price to earnings ratio on January 3rd of 2022, when the market peaked before that 25% correction. The main difference between today and 2022, though, is that the 10-year bond yield has risen to 4.4%, whereas it was only 1.6% in 2022. The higher bond yield suggests that the stock market is looking less attractive today than it did back then as well. Because as bond yields rise and the risk-free rate increases, it makes every other investment look less attractive. And therefore, stocks should be looking less attractive today than they did all the way back in January of 2022. 2007 gives us a good reference for when bond yields were historically around this level at 4.7%. And back in 2007, the forward price to earnings ratio of the market was 15.1. So we're around the same bond yield as 2007, but the PE ratio is about 30 to 40% higher. So personally, I do think that the S&P 500 as a whole is looking more on the expensive end. But if we take a look at the year 2000, right at the peak of the tech bubble, we can see that the S&P's forward price to earnings ratio was 25.2 at the same time as bond yields were 6.2%. This is what a true bubble looks like right here. So I don't think that we're quite at bubble territory right now. I just think that the S&P is looking quite expensive and that the future returns are going to be lower. Now, with that being said, this next chart shows us the estimated future returns over the next 1 and 5 years based on the historical data when the S&P was trading for this price to earnings multiple. The first thing that I notice is that it's very clear that as the price multiple expands, the future returns go down. This is just how investing works. As prices rise, future returns go down. So the higher the price you pay for an investment, the lower future returns you should be expecting. And based on the historical data, when the S&P has been trading for that 21.3 forward price to earnings ratio, the 1-year returns and 5-year returns have been about 5% annually. And based on this data, investors should be expecting around a 5% compounded annual growth rate to the S&P. So future return expectations are definitely going down. Now, moving on to the next screenshot, this one is coming from Vanguard, and they said, where to find value in the US markets. Further down in this article, they show that US equities are on the stretched end of the valuation range. They're actually in the 99th percentile right now. So Vanguard does believe that the US equities valuations are stretched, and I do agree. I think that the US markets are looking quite expensive. Now, in terms of where Vanguard is seeing value, it's in US value stocks and US small cap stocks. Now, I actually disagree with Vanguard here because I have been combing through the US stock markets to try and find new stocks, try and find interesting investments. I've looked at small caps, micro caps, mid caps, large caps, mega caps, all of it. And I think that the US markets as a whole are so combed through. I think everyone in the world is looking at them. And price multiples across the board, in my opinion, are actually quite high. So I am a bit surprised to see that Vanguard thinks that there is still outperformance or value in the US small cap and US value areas, because again, in my opinion, these areas are still quite expensive, even small caps. Further in this article, though, they say, following are highlights of the changes in our 10-year annualized returns forecast. US equities to return between 4.3% to 6.3%, and developed international equity markets to return 6.6% to 8.6%. So Vanguard is clearly saying here that they believe that the developed international equity markets, which are markets like Europe and Japan, are going to produce higher returns than US stocks over the next decade. And I do agree with this. And as I have told my YouTube channel recently, I opened up an Interactive Brokers account so that I could get access to the international markets. And since I opened up that account, I have been combing the international markets a lot. That's pretty much how I have been spending my weekends, is just screening for international stocks and trying to find value. And I can confidently say that there is a lot more value in the international markets right now. I am finding stocks that are trading for 10 times profits, growing 20% annually consistently, with high insider ownership and phenomenal balance sheets. They have all of the makings of being high quality businesses, and they're trading for 1/3 to a half of the price multiples as a similar business in the United States. So just because these stocks are trading outside of the US, their multiples are significantly lower. And I believe that a lot of them, again, their qualities are quite the same. So I do think that the international markets are offering a lot more value right now. And therefore, I do think that they could outperform over the next decade. And that's why I personally have been looking in the international markets and investing more in the international markets as well. This next screenshot shows us a chart of where Vanguard thinks their future returns of different markets are going to come from. So once again, US equities we can see is about 4 to 6%. Global markets excluding US equities is 6 to 8%. Developed markets excluding US equities is the highest percentage of returns here at about 6 to 8%. And then US value, US growth, and US small caps are all offering about 6 to 8, 3 to 5, and it looks like about 3 to 5 as well. And based on this chart, Vanguard does think that the highest performing stocks over the next decade are going to be in the developed international markets. And once again, I do agree with them on that one. Now, as I have been exploring the international markets, I have been seeing a lot of comments on my YouTube channel saying, well, international markets have always traded at a discount to the US markets because the US markets have the highest quality companies. I completely understand that argument, and I do agree with you. And in this chart from JP Morgan, they show us that the average price to earnings discount in the international markets relative to the US markets over the past 20 years, has been about 18.3%. So that's the average discount. However, as of May 30th, that discount got all the way to about 40%. And we can see that the discount is at a 20-year low. So the international markets are offering an extraordinarily high discount to the US markets right now. And this is why I am getting so attracted to them as well, is simply because all of the data is suggesting that value is truly not in the US currently. This next chart also gives us some more context. So currently the US markets are valued at about 21.3, that's the forward price to earnings ratio. And we can see that the 25-year average has been about 16.9. So the US is trading well above its historical averages. Now take a look at Japan in specific. Japan's forward price to earnings ratio is 14.4 right now, and its historical average has been about 17. So the Japanese stock market is trading about 10% below its historical average price to earnings multiples. And based on what I have seen through all of my research, I can confirm that the Japanese markets are looking extremely cheap. There are a lot of high quality stocks over there trading for sub 20 multiples, growing very strong, with what seems to be strong fundamentals as well. The only thing about Japan and all of these non-US markets is that you really do need an Interactive Brokers account to get access to them, because accounts like Robinhood or even Charles Schwab or JP Morgan, these brokerages are not going to give you access to those markets. This is why Interactive Brokers business, in my opinion, has been absolutely exploding, is because they're the broker that you need to get access to all of these different stocks. I am not sponsored by international brokers. I am an affiliate with them now though, but I can confidently say that this is the best brokerage for investing outside of the US. Their fees are incredibly low and they have so many freaking exchanges and stocks on their brokerage. So I'll leave a link in the description if you want to check out Interactive Brokers. Again, I've opened an account. I'm not sponsored by them. I am genuinely just saying this because they're the only brokerage that I have been able to find to give me access to all of these different stocks. So click the link in the description of this video if you are interested in checking out Interactive Brokers and potentially opening up an account. But with that being said, let's now move on to the next segment of this video, which is the 3 high quality stocks that I am paying attention to that are on my watch list and that I would love to own at the right price. So the first one is Microsoft. I think that everyone knows what Microsoft's business does. I think that this is probably one of the highest quality companies in the world. And I think that they have so many different moats surrounding their businesses and that this business will continue to grow for decades to come. So let's take a quick look at Microsoft's price ratios today. So as of right now, it's trading for a price to free cash flow of 51.4. Now, if we zoom all the way out to 2000 during the tech bubble, we can see that Microsoft's price to free cash flow at the peak of the tech bubble was about 49.4. This suggests that Microsoft's price to free cash flow is higher than where it was during the tech bubble. And I think that people may see this and think, oh, well, this stock is extremely expensive and this stock in specific is in a bubble right now. I would actually disagree with that. And I want to go through my thought process here with you. Microsoft and all of these other major tech companies are investing tens of billions of dollars into CapEx to grow their AI infrastructure and build data centers and all of that. So these companies are going through a massive investment cycle right now to continue growing their businesses over the long term. And when companies are going through massive CapEx cycles that I believe are actually going to produce returns over the long term, I think that it makes more sense to focus on their operating cash flows and therefore their price to operating cash flow ratio, because that massive CapEx cycle they're going through is going to significantly suppress free cash flows and make the stocks look a lot more expensive than they actually are. So for example, if we take a look at Microsoft's price to operating cash flow in 1999, it was all the way at 46, whereas today it's trading for about 27 times operating cash flows. So on an operating cash flow basis, Microsoft is still about half of where it was during the tech bubble. And personally, I think this makes the most sense to use. And when I take a look at this data as well, it doesn't look like Microsoft is trading near bubble territory or anything like that. However, Microsoft's long-term average price to operating cash flow multiple is around 20 to 21. And this is where I would become much more interested in the stock. So right now, I do think that the stock is still looking on the more expensive end with a higher multiple than its historical averages. And personally, I would just be much more interested in the stock if it does get down to a 20 multiple. Now, that would be about a 20 to 30% correction for the stock. So I'm not confident we're going to see that massive of a correction. I'm definitely not betting on us seeing a correction like that. But if we do, I like to be prepared. And if we do see a correction like that, then that is the area where I would start to become quite interested in Microsoft's overall business and stock. Now, the next stock that I think is extremely high quality and one that I would absolutely love to own is PANW or Palo Alto. Palo Alto offers multiple cybersecurity products like firewalls and cloud security. It's also one of the largest cybersecurity companies in the world. And the main reason why I am so interested in this company and the cybersecurity industry as a whole is because I think it's almost obvious that this industry is going to continue to grow. I think that cyber threats and cyber attacks are only going to continue to become more and more of an issue as technology advances and as our world becomes more and more digital. So I think that there are massive multi-decade tailwinds behind a business like Palo Alto. And with them being one of the leaders in the cybersecurity industry, I think they're going to benefit massively from these tailwinds, and this company is going to grow it's just going to continue growing for decades to come. If we take a quick look at Palo Alto's financials, we can see that back in 2011, they were doing about $112 million in revenue. And in the trailing 12 months, they have now done roughly $9 billion in revenue. They have nearly 74x'd their revenue over the past 14 years. And we can see that the company's revenue is clearly continuing to grow and hit all-time highs. However, if we take a look at a yearly basis and look at the percent change to the revenue every single year, we can see that the revenue growth is clearly decelerating. And in 2024, they had their lowest revenue growth year at 16.5%. This doesn't necessarily concern me because it's just the law of large numbers. When businesses grow, it becomes more challenging for them to maintain extremely high growth rates. Like if Palo Alto was going to grow 50%, then they would have to generate another $4 billion in revenue over the next year, which is much more challenging than them growing from $500 million in revenue to $750 million in revenue. So as businesses grow and have higher and higher revenue numbers, it becomes more challenging for them to maintain high growth rates. So I think that this is just a natural consequence of the business growing. But overall, I do still like to see that the business is growing by over 10% annually, and I think that it will continue to do so. So let's go and take a look at Palo Alto's price to free cash flow now. And we can see that it's trading for about 44 times cash flows today, which is just simply way too high for me. The company's long-term historical average has been about 30, so it's trading about 30 to 40% above its long-term historical average price multiples. And one thing I've been noticing amongst investors in the market today is that, someone would see something like this and say, oh, well, you should pay up for quality, or, this is a high quality business, so it's worth paying a high multiple for it. I do understand that high quality businesses should command higher multiples, but when we start to get up to the price multiples of like 40, 45, 50, 60, that's just that's too much for me. There's almost no business. I would actually say there's no business in the market where I'm going to pay a 40 multiple for it. I think that relative to what I am personally finding in the market, these prices just simply don't make sense. And I think that you can find extremely high quality businesses for significantly lower multiples, even right now. So I understand that Palo Alto is a fantastic business. It's probably going to continue growing for the next 2 decades. I'm still not willing to pay a 44 multiple for it because I don't think that investors should be willing to pay infinitely high prices just because a business is high quality. Also, to put this in perspective, Palo Alto back in 2023 was trading for a 17 price to free cash flow. This stock was not on my radar at the time, so I did miss it back then. And I wanted to highlight this to show you that these high quality companies do sometimes trade for low multiples. So this is just a recent phenomenon, in my opinion, where all of these US stocks have become extremely expensive and investors are just saying, you know what, well, we should just buy quality at any price. I disagree. And I think that, people should be patient and wait for better entries on even high quality stocks. That's just my opinion. But yeah, Palo Alto is definitely a stock that I think is extremely high quality, and at the right multiple, I would definitely be interested in taking a position. But right now, it's just unfortunately not there. Now, the third stock that I want to talk about is MSCI. I think that this is another extremely high quality business, and I think this one is arguably trading for a fair multiple today. But first off, let's discuss what MSCI does. This business provides the essential ingredients or recipes that help big investors understand and invest in different parts of the global financial markets. They're behind many of the funds you yourself may invest in, even if you don't realize it, because their indexes are the backbone for how many investment products are built and measured. Investment firms, like those that run mutual funds or ETFs, want to offer products that track these specific market segments. So they pay MSCI a fee to use their indexes. Basically, this company provides the information that allows ETFs and mutual funds to create products and actually exist. So they're heavily involved in the financial industry, and I think that this company has a massive data moat that is going to continue to be there for decades to come. Now, if we take a look at MSCI's financials, we can see that its revenues have been consistently growing over time. There are periods where revenue growth does slow down, but over the past decade especially, they have been continuing to grow revenue by about 11% per year. Since 2013, the company's operating cash flows have continued to compound by about 15.5% annually as well, which is a very strong growth rate. Now, if we take a quick look at their cash flow statement, here are some of the things that I really like to see as well. We can see that operating cash flows in the trailing 12 months was that 1.5 billion, and stock-based compensation was only $100 million. Relative to the company's operating cash flows, this is a pretty small amount of stock-based compensation, especially for a high-quality company that just continues to grow. Their investments in property, plant, and equipment, or the capital expenditures, is also very low relative to the amount of operating cash flow the business produces, which means that they do produce a significant amount of free cash flow. And here we can see that free cash flow was about $1.38 billion in the trailing 12 months, which means that roughly 90% of the operating cash flows became free cash flows for the business. So this is a highly profitable and growing business. Now, what's also interesting is MSCI is using a lot of their free cash flows to buy back shares, which has resulted in the company's share count declining by about 3.7% annually over the past 12 years now. So their share count is declining, and this is also creating more shareholder value. In fact, if we take a look at MSCI's free cash flow per share since 2013, it has been compounding by about 20.3% annually over that time, which is a fantastic growth rate to the company's free cash flows on a per share basis. Now, what's also interesting is MSCI is trading for about 30 times cash flows today, and its long-term historical average has been about 33.4. So the company is growing its free cash flow per share consistently by about 20% per year. I believe that this company has a massive data moat, and it's trading about 10% below its long-term average price to free cash flow. We can also see that its share price has now been flat since about 2021, or about 4 years now, despite the company's revenues and profits continuing to grow quite quickly. And due to the company's share price being flat over the past 4 years, while its fundamentals have continued to grow, its multiples have compressed down to that 30 price to free cash flow. So this is one that I think is worth adding to a watch list and researching more, for all of the reasons that we have discussed. I think it's a high quality business. It's consistently growing. I do believe it has a moat. Its price multiples are below its long-term historical average. It's buying back shares, and all around, it just seems to be a great business. And to be transparent, I have not purchased any shares of this stock yet, and this is partly because I have been exploring the international markets and focusing my attention over there. But in terms of the US markets, I do think that this one could be looking quite interesting. All right, let's now move on and take a look at Adobe stock. And this is one that I've been getting asked about a lot over the past month or so, because Adobe reported its earnings, and the stock is down roughly 40% from its recent highs. And its share price is now back down to $378. Now, Adobe is actually a stock that I owned at one point. I bought it in this massive dip right here when the stock was $277, and I sold it up here around $512 per share for around an 85% gain within a year. So now that the stock is back down roughly 20% from where I sold it, a lot of you are asking me if I am considering buying back into this position. So let's take a look at Adobe's recent earnings and the highlights from it. In this screenshot, we can see that Adobe achieved a record revenue of $5.87 billion for its second quarter of fiscal year 2025, which represents an 11% year-over-year growth. It also had a record quarter for operating cash flows of $2.2 billion, and the CFO said, as a result of us driving strong performance in the first half of the year, we are pleased to raise Adobe's full year 2025 total revenue and EPS targets. So in the second quarter, Adobe produced record revenue, it had a very strong quarter for cash flows, and they raised their full year targets. So let's take a look at those targets now. This says that for the third quarter, Adobe is expecting around $5.9 billion in revenue, and for the full year of 2025, they are expecting about $23.55 billion in revenue. This is year-over-year growth of 9% for the next quarter, and 9.7% growth for the full year of 2025. So it seems like Adobe is expecting its revenue growth rates to decelerate in the second half of the year because they just had an 11% quarter. And again, for the full year, they're expecting about 9.7% growth. So they're expecting the growth rate to come down heading into the remainder of the year. So let's head back over to Stock Unlock now, and we can clearly see that Adobe's revenue is hitting an all-time high of about $22.6 billion in the trailing 12 months. And it looks like the company's revenue growth is very consistent and it's just continuing to grow. Adobe's operating cash flows are continuing to grow very strong as well. They're at an all-time high in the trailing 12 months of $9.62 billion now. Adobe's free cash flow also just hit an all-time high of $9.44 billion. So the company's revenue is continuing to grow strong and its cash flows are at an all-time high. And the company's price to free cash flow is sitting at 17 now, which is a 5.8% free cash flow yield. So this company is looking quite attractive on a financials basis. I mean, the revenue growth is there. Its revenues are hitting all-time highs. Its profits are hitting all-time highs. And its revenue growth rates are maintaining above 10%. Now, that level of growth, 11% revenue growth at a 17 price to free cash flow for a high-quality software business is actually looking quite attractive. And again, just based on the financials, this business is looking cheap in my opinion. The question is Adobe really going to be disrupted by AI over the next 5 to 10 years? Because I don't just invest in the financials of the business today. I don't invest in what is the price of the business today. I have to be absolutely confident in the business's future and its future growth. And with Adobe right now, I do have a pretty big question mark over if AI is going to disrupt this business. Because what I have seen from AI so far, when I think about the potential for it to disrupt a business, I think Adobe's disruption potential is actually quite high. If you go and take a look at Google's VO3 video prompting software now, it's not quite production level. There are still some errors in it, but it's getting pretty dang good. And where is that technology going to be in 2 to 3 to 5 years from now? Because we all know it's only going to be continuing to get better. So I don't know if AI is at the point now where it's production quality and you can prompt in videos that are going to disrupt Adobe right now. But within the next 5 years, that tech is only going to continue getting better. And at some point, I do think that it could disrupt Adobe. So for me, it's just, I don't know. And whenever I don't know about the future potential of a stock, or I don't feel certain or confident in it, then I don't buy it. Even if its revenue is growing today, and even if its price multiples look attractive today, I've got to feel certain in that business. And even as a user of Adobe, like I edit all of my YouTube videos on Adobe, but what I have been doing is trying to pay attention to what are all of the latest AI video editing softwares coming out, and how is AI improving the workflow of getting content out? Because eventually I think that AI is going to be editing videos. And as soon as I see a single AI video editing software that can replace Adobe for me, I'm going to be very interested in using it and potentially replacing Adobe. The reason I'm stuck with Adobe right now is because I am very familiar with the platform. And when you're familiar with a video editing software, it becomes quite sticky because it's a huge hassle and learning curve to learn a new technology and software platform. But if there's something that comes out that can chop up the video, do all of the cuts whenever I mess up words, I'm sure you guys see how many cuts I do in a video. That's because I lose my train of thought, or I mess up words, or I want to say something better. So if AI can get to a point where it can read the script, find the most intelligent flow of the video, and cut out all of the fluff, and if it can do that on its own, then it would literally save me hours of time. And I would be very interested in using a tool like that. So yeah, I think AI is going to get there. I mean, if we take a look at where the future is going, I definitely think a product like that is going to come out at some point, probably sooner than we think. And when it does, as a user of Adobe, I could see myself switching. That's a long way for me to say the metrics of Adobe do not suggest that its moat or its business is being successfully disrupted right now, but that doesn't mean that in the future it cannot be disrupted. And I would say personally that I think this company does have a high chance of being disrupted by AI based on what I have seen come out. So for those reasons, I am no longer interested in owning Adobe stock. And personally, I'm just gonna move on. You don't need to own every stock just because it's looking cheap. If that were the case, then I would own PayPal. I would own a lot of stocks actually that I don't necessarily feel bullish on. So you don't have to own everything. It's okay to pass on stuff. And that's how I feel about Adobe. Now, the next portion of the video that I want to talk about is in regards to Amazon, which is actually a stock I own. So the CEO of Amazon came out, and in this article, he said that he believes that Amazon's overall workforce is going to start shrinking because of AI. With Amazon's business, AI is getting to the point where it's increasing productivity and efficiency so much that they don't need as many employees. So here in this article, this reads, today we have over 1,000 generative AI services and applications in progress or built. But at our scale, that's a small fraction of what we will ultimately build. We're going to lean in further in the coming months. We're going to make it much easier to build agents and then build or partner on several new agents across all of our business units and G&A areas. As we roll out more generative AI and agents, it should change the way our work is done. We will need fewer people doing some of the jobs that are being done today, and more people doing other types of jobs. It's hard to know exactly where this nets out over time, but in the next few years, we expect that this will reduce our total corporate workforce as we get efficiency gains from using AI extensively across the company. As we go through this transformation together, be curious about AI, educate yourself, attend workshops, and take trainings. Use and experiment with AI whenever you can. Participate in your team's brainstorms to figure out how to invent for customers more quickly and expansively, and how to get more done with scrappier teams. When I first started at Amazon in 1997 as an assistant product manager, I worked on leaner teams that got a lot done quickly and where I could have a substantial impact. We didn't have tools resembling anything like generative AI, but we had broad remits, high ambition, and saw the opportunity to improve and invent so many customer experiences. Fast forward 28 years, and the most transformative technology since the internet is here. Become conversant with AI, help us build and improve our AI capabilities internally and deliver for our customers. We'll be well positioned to have high impact and help us reinvent the company. This is Andy Jassy basically saying, well, there's a few things here. Number one, he's saying that AI agents and overall generative AI is going to cause some of the jobs that people are doing right now to disappear. But he's also saying that generative AI is going to create new jobs. He doesn't necessarily know where this is going to net out over the long term, or like if there's going to be a net loss of jobs. But his speculation is that over the next few years, Amazon's total workforce will shrink due to all of the efficiency gains that they're getting from generative AI. Then what he is suggesting to people, your everyday person, is to start interacting and learning AI as much as you possibly can and as quickly as you possibly can. Because what these companies want is people who know how to work with AI and use AI efficiently. And if you're someone who is not using AI or learning how to use AI in your own workflows to make you more efficient, then it sounds like he's saying you're going to be left behind for a company like Amazon. Like, that's not the type of employee that Amazon is going to be looking for. Yeah, I think this is just where we're at in history. And I think that, it is a good idea for everyone to learn how to use AI. I'm starting to use it a lot more in terms of coming up with script ideas with my writing, and it's getting pretty freaking incredible what AI can do. I said recently in one of my previous videos that I do see a future where people are going to be prompting videos and YouTube is going to be absolutely flooded with AI generated content. That's going to be a weird future, man. I don't necessarily know what that's going to mean for content creators when there's just a flood of content, especially when it gets to the point where you're not going to know if a human is doing it. Like, again, I said this in my previous video, but I could be an AI right now. And I think that AI is going to get to the point where it's going to be so good that you're not going to know if a human is behind the camera or not. And when that happens, I just don't know what that looks like for me as a content creator and for YouTube as a whole. But yeah, this is what Andy Jassy said. And what this most likely means for Amazon's overall business is that it is going to continue becoming more efficient and more profitable. My whole investment thesis for Amazon is that its highly profitable business segments like AWS and advertising are going to continue to grow and become larger and larger portions of the business. And when they do, and as they do, the profit margins of Amazon will continue to expand as they have been for the past 20 years. So Amazon seems like they are continuing to pursue more profit margin expansion by leveraging AI and making the overall company much more efficient. Now, on that note, here are the growth rates of the top 4 big advertising giants. This is Amazon Advertising Services, YouTube ads revenue, Google search and other revenue, and Meta advertising revenue. And what I noticed in this chart is that Amazon's advertising revenue has been the most resilient recently. We can see that all of these companies' advertising growth rates have been coming down. And in the most recent quarter, there was a pretty big deceleration in growth across YouTube and Meta. However, if we take a look at Amazon, they had a really resilient quarter and still saw 18% year-over-year growth to their advertising business. So Amazon's advertising business is the fastest growing advertising company out of these 4, and it also seems to be the most resilient. And as this business continues to grow, I do think that Amazon's overall profit margins will continue to expand. So let me show you what I mean if we head over to Stock Unlock here right now, and we head over to Amazon's financials. Let's go and take a look at its gross margin here. And we can see that since about 2011, Amazon's gross margin has been expanding quite a bit, and it is still continuing to hit all-time highs. In the trailing 12 months, they've had a gross margin of 49% now, whereas back in 2011, it was 22.4%. So Amazon's gross margin has more than doubled over the past about 14 years now. And as I have continued to say, I think that this trend will continue and maybe even accelerate with the adoption of AI, and as Amazon gets those efficiency benefits from leveraging AI even more. Now, in terms of Amazon's price today, I think that the stock is probably selling below fair value still. Its price to operating cash flow is still right around 20, which is well below the company's historical averages of about 25 to 27. So the company is trading below its historical average price multiples. And that does suggest to me, at least, that the stock could be offering value today. But I don't think that Amazon is an absolute steal in the market anymore. Like when it was in these corrections recently, I thought that the stock was a steal, and I have been continuing to buy Amazon whenever it does see strong dips like that. But with the stock recovering, I think something like 30% now, I think that the large discount is gone and the stock is probably selling below, but pretty near to fair value. So Amazon is not a stock that I'm actively adding to my portfolio at this price, but whenever this stock does see dips, it is one that I do nibble on and buy some more shares of. So that's what I wanted to update you all with Amazon, because I thought that this news was pretty interesting. All right, let's now move on to a quick discussion about Brookfield Corporation and why I think that the company is better set up right now to continue growing in the future than ever before in the company's history. So I went back to Brookfield's 2014 annual report and I made a pie chart of where the company's cash flows came from. Brookfield is a conglomerate that owns multiple different business segments, and this is how the business segments looked in terms of how much they distributed to the company's overall profits. So back in 2014, BAM was 21% of Brookfield's profits. Brookfield Property Group, which is their real estate business, was the largest contributor at 38%. So Brookfield's, well, not the majority, but the largest contributor to profits was real estate. Then 20% was Brookfield Renewable Partners or Renewable Energy. Then about 11% was Brookfield Infrastructure, and the other 11% was other. So back in 2014, what this chart is showing us is that the majority of Brookfield Corporation's profits were coming from BIP, BEP, and real estate. Only 21% of the profits were coming from BAM. So let's fast forward to today and take a look at how Brookfield's profits are broken up now. And we can see that Brookfield Asset Management is now 30% of the company's overall profit contributions. The Wealth Solutions business is now 28%. And for those of you who may not know, the Wealth Solutions business is brand new to Brookfield. I believe that it was formed in the year of 2021. And within just 4 years now, this has gone and grown to become more than 25% of the company's overall profits. And this business alone is projected to 3x its profits over the next 5 years, which means that the Wealth Solutions business, well, it's a large portion of the company's overall profits now, and it's projected to triple. So the company's profits could continue to grow massively over the next 5 years. Then we can see that Brookfield's investments are producing about 15% of their overall profits now, and Brookfield Property Group has declined all the way to 14%. This is because the other segments of the business have grown so much more rapidly than the real estate portfolio over at Brookfield. It has compressed that profit contribution down to 14%. BEP is only 7%, BIP is only 5%, and BBU now is 0.4%. So back in 2014, BIP, BEP, and BPG were the vast majority of Brookfield Corporation's overall profit drivers. And today, these three businesses, well, really all of the subsidiaries of Brookfield, make up, what would that be? About less than 30%. This is less than 30% of where the company's profits come from today. 30% essentially comes from Wealth Solutions, 30% from BAM, 15% from investments, and then the remainder is from its legacy businesses. BAM is a fast-growing business, and as we've already discussed, Wealth Solutions is also an extremely fast-growing business. In fact, in 2024, Brookfield gave us an outlook for how quickly they think their different business units are going to grow. And BAM is projected to grow by 18% annually over the next 5 years, and ultimately end up producing about $3.7 billion in annual earnings for Brookfield Corporation. The Wealth Solutions business in 2024 produced about $1.4 billion in earnings, and by 2029, it's projected to more than triple that to $4.8 billion in annual earnings, which is a 28% compounded annual growth rate. And again, this is a business that didn't even exist before 2021. So when I look at the makeup of Brookfield Corporation's assets today versus their assets historically, I do strongly believe that this company is better set up for future growth than ever before in the company's history. This is what the CEO, Bruce Flatt, has also been telling investors. And it's because he's been telling us this that I wanted to dig into why it is. And when I started to look at the breakup of Brookfield's assets historically versus what their assets are today, they have a lot higher quality businesses and assets on their balance sheet today that are projected to grow significantly over the next 5 years and over the long term. So this is why Brookfield's business could accelerate over the next 5 years, and why I think that their aggressive targets could be met, and also why their historical growth rates are probably going to be lower than what the company is going to produce over the next 5 years. So I thought that was interesting after I dug through the reports, and I wanted to share that information with you. And this is a really good segue to the last portion of the video, which is where I want to talk about how a real investor's portfolio looks as someone who is constantly adding to my positions, averaging up, and just dollar cost averaging certain positions within my portfolio. So this is Brookfield Corporation. This is my real position throughout all of my portfolios, my consolidated portfolio. This is my position in Brookfield Corporation. So I own $290,000 worth of Brookfield Corporation stock today. It's the largest position in my portfolio. makes up about 22.68% of my portfolio. And we can see that my gains are $70,000 or about 31.7% on the entire position. Now, if you're someone who's been watching my channel, you may be looking at this right now and being kind of shocked because I've been talking about Brookfield since 2022 and the stock has more than doubled since I have started talking about it. So you may be thinking, well, if the stock has more than doubled since Daniel has talked about it, then why is his overall position only up 32%? And the reason is because I have consistently been averaging up on my Brookfield position for the past 3 years. If we go back and take a look at some of my first buys, well, I was buying Brookfield throughout 2022, but on November 18th, 2023 is when I imported everything into Stock Unlock, which is why this is the first buy. But anyways, on Stock Unlock, this is my first buy of Brookfield Corporation. And we can see that in terms of percentages, I'm up about 67 or 68% on this buy. On the next buy, I'm up 78%. And on the next buy, I'm up 90%. So when you go all the way back to 2023 and look at my first buys on Stock Unlock on Brookfield, the percent gain is very, very high. And what I've seen a lot of YouTubers do is when they buy a stock, and let's use my Brookfield example here, okay? So let's say I had a YouTube portfolio that, I tracked or whatever on my YouTube channel. What I've noticed other people do is they will only track their initial buy of the stock. So if I had a YouTube portfolio, I would only track the first buys I did on that stock so that my percent gain on the position could look as high as possible. In other words, what I have noticed is a lot of people on YouTube are not showing what it looks like to continue averaging up on positions. They just want to show you the highest percent return possible to make it look like their performance is as good as possible. But as we continue looking through my Brookfield buys, we can see that the percent gains start to go down as I average up on this position over time. Let's continue looking. Now we're getting into the 30%. On this next page, we're getting into the single digits. I even had a negative buy right here on in December of 2024. And as we continue looking, we can see that the buys do get lower, or the percent changes do get lower and lower and lower. And what this overall does is lower my total percent gain on the entire position as I average up and buy shares at a higher price. So if I wanted to make my portfolio look as good as possible and make my percent gains look as high as possible, then I'm actually incentivized to not average up on my positions. So again, this is why I see YouTubers not necessarily talking about averaging up or not averaging up in their portfolios so that their percent gains in their portfolios can look as high as possible. And I think that this kind of does a disservice to every investor because this is not the reality of investing. The reality of investing is that as you earn money, you naturally put more money into your portfolios and you average up on your positions. And when that happens, your overall percent gain on the positions declines. That is what I have experienced in my own portfolio. And that's just how it works. So if you're ever looking at a YouTuber's portfolio and you're like, well, hey, why is Daniel up 90% on his Brookfield position, but I'm only up 40% on mine over the past, we've been buying since 2022 together. It could be because this theoretical Daniel has not averaged up in his YouTube portfolio to make his percent returns look as high as possible. And I think that's just not a reflection of reality. So I wanted to talk about that and show you how my own Brookfield position looks. Even though I started buying this stock in like the $40 range and my initial buys are actually up over 100%. I am editing this video right now, and I think that I can do a little bit more of an in-depth job to explain why I think investors should be willing to average up on their positions and why you shouldn't be scared to do so. So let's continue on with my Brookfield example right here. Now let's look at this buy right here, which in Stock Unlock is my #1 buy in terms of percent returns. And let's say that this was my first buy right here on Brookfield of $42.78. Well, as the stock continued to run up, let's say that I didn't want to buy anymore because my average was lower and I wanted to maintain my average. Well, if I did that and I only kept this buy right here, then my total returns on Brookfield right now would be $271 if we want to round up. But as you can see, through me averaging up, I have made a net of more money. For example, right here on January 4th of 2024, I bought about $2,600 worth of Brookfield shares. This was an average up from this buy right here, but I made an extra $1,500 or 60% on this position. So as an investor, I am not prioritizing my net percent gain on the position. What I am prioritizing is the net amount of total dollars I will make on the position. And this is the switch that I think a lot of investors should be making in their portfolios, is not prioritizing your percent gain, but prioritizing the amount of cash that you have invested in what you believe are high quality companies and the net dollar amount that you end up making on the position. Because as we saw, my net gain on my BN position now is over $70,000. And this was only achieved by me averaging up and continuing to plow more money into the stock as its share price has risen. So for me personally, I am not trying to protect my percent gain on a stock. I am just trying to load as much as I can into it so that I can make as much money as possible over the long term on that stock. And I hope that by me explaining this, you can help shift your thinking to not prioritizing or protecting your percent gain and just continuing to buy stocks that you believe are high quality when they're selling for fair prices. Now, additionally, I want to talk about why I am so happy to average up, because this is a topic where I think people really struggle with averaging up. So on Brookfield, again, I initially started buying the stock, well, all the way back in 2022, and then I was buying it heavily here when the stock was at its lows and throughout 2023. As you guys know, I could not shut up about Brookfield during this time because I truly believed that it was significantly undervalued, and I made it the largest position in my portfolio by far, and it's worked out so far. But how I continue to average up, because I'm still buying shares of Brookfield in the market today, is because I'm focusing on its fundamentals and what I believe the value of the business is relative to those fundamentals. I don't care what the share price has done. And I don't think that people should get, I believe it's called anchoring bias based on where you have bought the stock historically. Like, for example, if someone bought the stock over here at $32 US, then they may be anchoring their current analysis or thoughts on the stock today based on where they have previously bought the stock. So they may think the stock is expensive today just because they bought it 50% cheaper. I don't think that this is how investors should look at share prices personally and look at investing as well. I think that every investment decision should always be based on the fundamentals of the business, and if the price of that business relative to its fundamentals are still attractive. And on Brookfield, I personally believe that the price of the business relative to its fundamentals are still attractive and the stock is still undervalued despite it selling right near all-time highs. So in this situation, I am still happy to continue averaging up and loading into the stock and nibbling pretty much whenever I can, because I think that the fundamentals versus price is still extremely attractive. So I just wanted to talk about that and let you guys know that I'm happy to buy stocks at all-time highs as long as I believe the value is still there. And yeah, just wanted to talk about what real investing looks like, what a real portfolio looks like, and how my Brookfield position is looking right now after I've averaged up and continued to buy so much over the past really 3 years now. But with all that being said, that is going to wrap up the video, everyone. If you did enjoy today's video, please remember to leave a like on it. And if you're interested in getting access to my full portfolio, getting monthly portfolio updates, so much more content from me, access to my Discord community, even access to my new course that I'm working on, you can pre-buy my course through my Patreon now, then consider checking out my Patreon. It's only $15 per month, and you get all of the benefits that I just talked about. People have been absolutely loving it, and I've been getting great feedback, and I think that you'll love my Patreon too. So check out my Patreon. Again, it's only $15 per month. And with all that being said, thank you all so much for tuning in to today's video. As always, I truly do appreciate it, and I really hope to see you all again in my next video.